Okay, chapter 13, where this is financial accounting, and we're just getting ready to do chapter 13's intro problems. This chapter is the cash flow statement. So we've waited till almost the next to the last chapter in our book in order to learn how the cash flow statement gets put together. Don't get too worked up about it. I remember this being one of the most difficult things I went through in learning accounting. If somebody just would have set me down and said, now wait a minute, here's what we're getting ready to do. I'm going to tell you guys what we're getting ready to do. I'm going to show you a cash flow statement. Okay, I'm going to show you a cash flow statement. So hang on just a minute. I'll go get my spreadsheet. Let's look at a cash flow statement. It's evaluating your cash account, right? We have a cash account. In fact, it's usually one of the busiest accounts that we have because we use it a lot, right? You have to pay bills out of it. Eventually, customers will pay us eventually cash somewhere along the way. So we want to know how much cash we have, how much we had in the beginning, and how much we have now. And we want to know what happened to that cash, what made it go up, what made it go down. And that's basically what the cash flow statement does. Okay, so just a minute here. I'm going to get this going and take this back down. Okay, and so I wanted to start with what a cash flow statement looks like. And here is one. Okay, here is a cash flow statement. So if everybody could just watch and listen for just a few minutes, I would appreciate it. This is in the book. Okay, it's in the book. Let me make it big enough for you to read. At least I think you can read it. So here's what I want you to see. Okay, here's what I want you to see. Go to the bottom of the statement. Go to the bottom before you do anything else. Here's what I want you to know. Okay, you're basically going to report how much the cash is at the end of a period of time. Does everybody see this? So this is how much we have in cash. We've already done the cash reconciliation, so we know it agrees with the bank. All right. The bottom of the cash flow statement has the ending balance of our cash account. Okay. Right above it is the beginning of the cash account. So here's what I'm talking about. If cash is $97,500 at the end of the period, it started with $26,000. That's different, right? Our cash has gone which direction? Our cash has gone from 26,000 to 97,500. What caused that to happen? Well, you say, well, that's a difference of, and yes, there is a difference. How much was it? You can see it right here on the statement. It's a difference of 71,500, but that 71,500 going up in cash was actually a combination of three things. Okay, here's what we need to know. In the cash flow statement, we have an operating section. Okay, notice this says the first section of your cash flow is called cash flows from. From means that it went up. Used for means it went down. Okay, so that's a positive cash flow or a negative cash flow. There is a certain recipe to put this in here, and we're going to learn this. This is called the indirect method of the operating section of the cash flow statement. If you get finished, when you get finished with this section, you should know, based on our operations of this business, that the operations of the business actually caused cash to go which direction? It caused it to go up, and it caused it to go up $100,500. You say, well, wait a minute, I thought we went up $71,500. You're right. We've got two more sections to look at. And each of these sections is going to have either a positive cash flow or a negative cash flow, right? So the next section is called investing. Investing. Operating, investing, financing. Memorize that. Operating, investing, financing. Those are the three sections. 1, 2, 3. No, it's not in alphabetical order. So O-I-F. O-I-F. That's how you're just going to have to memorize it. Okay? And like I said, this is going to be a certain recipe, which I'm going to teach to you as we go through the problems, and the cash flow from the investing and the cash flow from the financing is going to be what's called the direct method. So here's what I'm going to put on the board. Okay, I've got the cash statement of cash flows. By the way, it's for a certain period of time, right? It's for a period of time. How do you know? Because it's got the word statement in it. At the bottom of a cash flow statement, once again, it starts with the ending balance. They said the ending balance in cash. Here's the thing, you already know what this statement must balance to. You know what the statement must balance to, because at the bottom, it will always show the ending balance. The beginning balance was $26,000. Okay, so the cash increase, the net increase in cash was $71,500. So right above this, we have to prove this cash flow, right? Net, okay, they call that net increase in cash. So because of what we did for this year, it's the year ending December 31st, year 8. Because of what we did, our cash increased by $71,500. That's the difference between the beginning in cash and the ending. So we've got to use these three sections. Section 1 is operating. Section 2 is investing. And section 3 is financing. This one, we're going to use what's called the indirect recipe, indirect method. Okay, there's a certain recipe for this section up here. Investing is going to be what they call direct, and financing will be direct. So if you look at this cash flow statement, I haven't even taught you the recipe, but because of the operating section, it had $100,500 in net cash flow. Okay, so this caused cash flow to go up because of operating. If you look at investing, by the way, when it comes to directly reporting cash, you always put positives before negatives. Okay, so the investing section actually made cash go down. Okay, it made cash go down by $3,000. Okay, so when you make it go down, a decrease is used. Okay, a decrease is used. Net cash flows from makes cash flow go up. So the word, I want to make sure you know these words. And let me put these over here. If you see the word used in the cash flow statement, it means a decrease in cash flow. Okay, If you see the word from, I'll put that above this one. If you see the word from, then that means an increase in cash flow. Okay, so if you look down here, both these two sections, the investing section and the financing section, actually cause cash to go down, okay, from whatever we did in those sections. So here's what we've got, okay? We're going to add these three together, right? We're going to add them. We're going to net these. And that's exactly the difference in the cash. Does everybody see this? 71,500 is exactly the difference in the cash. Okay. So I don't know if you could see the screen, but here's what we've got. We had a positive cash flow from operating. That's the $100,500. We had, oh, it's not showing up now. Just a second. Okay. We had a decrease in cash. Notice the word used for the investing. So I made 3,000 go down because of investing here. And then the financing section also caused cash to go down. So these two sections caused cash to go down. This caused cash to go up. And the net of these three is the $71,500. Okay, so one more time, if I was to put the operating section amount of 26,000, and if I was to put the investing section amount of a negative 3,000, and the financing section of a negative 26,000. Okay, I put this in the wrong spot. Just a second. I need to fix this. Okay, this actually should be $100,500. There we go. If we net these, this is your net increase in cash. How do you know it's a positive number? Because these two subtracted still leaves us with a positive number. Okay, so if you have a positive number, then you've had an increase in cash. So this is the net increase. And I can make those add up to $71,500. So basically, that's what you're doing here on the cash flow. What I like about the cash flow statement, at least now that I know more about it and have been teaching about it for a long time, you already know what you have to solve. You already know the amount that you have to come to. Okay, so all right, let's get to work. Okay, let's get to work. I'll teach you. This is the indirect method recipe, and I'll be writing it on the board too over here, I think. But let's go ahead and start some of the intro problems. The hardest part about this cash flow statement is it does take some detective work. You have to be able to look at the balance sheet or the income statement and get information off of it to see what's happened. Okay, but I am going to put the operating section over here, and I'm going to do a recipe. Okay, so operating section. This is the statement of cash flows. Okay, operating, it's going to use what's called indirect method or recipe. Okay, seems like recipe sounds better than method. There's the first section. The second section is investing. Okay, it's going to use what's called the direct method. And then finally, the third is financing. And it uses the direct method. So you say, what's direct and indirect? Let me start with these. You're going to show inflows of cash because of certain activities that we do in business. You're going to have inflows minus outflows. So you're just going to simply put, we got cash because we did this. We spent cash because we did this. And you're going to have an amount, right? So this is an amount, investing amount that caused cash to go up or go down. Same with this one. This one, we're going to show the inflows first, and we're going to subtract the outflows. Okay, and then we'll get a financing amount. Okay, here comes the recipe. This is the recipe for the operating section up there. Okay, I'm going to move this over here so I have more room. You start with, so if you don't mind, Casey and Haley, what do we start every operating section with? What does that say? Yeah. So we've got to look on the income statement. So, and start with a number, okay? We are not going to go out and look to see what caused cash to go up because of our operations, because this is a little bit simpler method, okay? So we're going to always start with net income. So we've got to do the income statement first. We've got to do the owner's equity statement. We've got to do the balance sheet and then the cash flow statement. Okay, so we're going to start with, always start with net income. That's the very first amount. Whatever we came up with. You say, what if it's a net loss? Well, we would start with that. Okay, but we would start with a negative number. So anyway, we're going to start with net income. Now we're going to make a series of adjustments. What's an adjustment? Up or down? Depending on what happened. Okay, so we're going to make some adjustments to this number. Okay, and so it just depends, either up or down. So the first thing, most businesses have fixed assets, furniture, automobiles, buildings, equipment, software. Okay, they're going to have depreciation. So the first thing we do is we add depreciation. I don't know of any business that doesn't have depreciation of some sort. Okay. So what do we do with depreciation? We add it. Does everybody see that? Okay. So that's the first thing we go and find. So you got to go find what the net income is. Okay. So I'm going to start with this one. So this is starting with a net income of 108,000. We add depreciation. Okay. Then we look and see, did we have any gains or losses on anything we sold? Did we have any gains or losses? If we have gains or losses, we subtract a loss. Okay, it just depends. If you don't have a loss, then you don't put it in there. But if you have a loss, you subtract it. If you have a gain, you add it. Right? Looks to me like they have a gain here. I have that backwards. That's gonna, okay. Let's start over. A loss is a positive adjustment. A gain is a negative adjustment. They didn't happen to have any losses, but they had a gain. So the gain gets subtracted from, so once again, we're going to start with net income. We're going to add depreciation. There were no losses. There was a gain. What do you do with that gain? You subtract it. Okay, you subtract it. You say, why? It's because that's what the recipe tells you to do. That's all I'm going to tell you. That's what the recipe says. Okay, so now we're going to look at our current assets. Okay, current assets and liabilities. Okay, and this is where things can get kind of rough. Okay, so here's what you need to say. I want to look at current assets. If an asset, and we're going to, when we look at these current assets and liabilities, we're going to look at the change. Did that asset go up or did it go down? Did that liability go up or did it go down? So we want to put current assets and liabilities changes. Changes is the big deal. So if you have an asset that went up, okay, so let's just put asset. Current asset. If you have an asset that went up, then you subtract the change. Okay? If you have an asset that goes down, then you add the change. Okay, now that's kind of tough. How about liabilities? If you have a liability that goes up, it's the opposite. You add the change. Okay. And then finally, if a liability goes down, you subtract the liability change. Okay. And so you got to look at all of them, right? So notice what happened. They have an increase in accounts receivable. Okay. So I'm going to make this, I should have moved this over. Now let me move it over. All right. One more time. If an asset goes up, we're going to subtract the asset change, the amount it changed. If an asset goes down, we're going to add the asset change. If a liability goes up, we're going to add the liability change. And if a liability goes down, we're going to subtract the liability change. Here's the easy ones. Liabilities go the same direction, right? Yep. It's the assets that give us troubles and make things confusing. So I'm going to go through these. So accounts receivable, that is a current asset. What happened to it? It increased $9,000. What are we supposed to do when an asset increases? We're supposed to subtract the amount it changed. So that's why that one is showing a negative 9,000. How about an inventory? Inventory is a current asset. It went down. What do you do when an asset goes down? You add the change. Well, our inventory changed by $8,000, so we're going to add the change. Okay? The next one is a decrease in accounts payable. So that's this one. A decrease in accounts payable. Our decrease in accounts payable is $3,200. And then we had an increase in accrued expenses payable. That's another current asset. When your liability goes up, you add the change. And then this last one here, we don't include increase in, well, we do include a decrease in income taxes payable. So that's this one, okay? Decrease in income taxes payable. So if a payable goes down, you subtract the change. All right. So if you take 108,000 plus 7,000 minus 12,000 minus 9,000 plus 8,000 plus 2,200 minus 3,200 minus 500, you get $100,500. That is the net cash flow from operating activities. Net cash flow, and the word is from. The word from means it's an increase. Okay, net cash flows from operating section. Okay, that's how that's working there. This is the recipe. Okay, so I don't know if those of you on Zoom were able to see that, but this is the recipe. Okay, so one more time, I'm going to go ahead and put this in a little, let me put this in a little bit of a formula. Okay, here's the formula. You start with the net income. You add depreciation. Now you say, well, what if we don't have depreciation? If you're in business of any kind, you'll have some form of depreciation. Okay, so I don't think we do any that doesn't have depreciation. So you're always add depreciation. It doesn't matter what happens, you will always add it. Then you're going to look to see if you have any losses. Okay, if you have any losses, you're going to add them. If you don't have any losses, then you just don't put that in there. You can't create anything that hasn't happened. Okay, but if you have any losses on any sales that you made, a loss on usually a fixed asset. If you have any gains, gains get subtracted. So once again, it's a matter of whether this happened or it didn't in the business. If you had any gains, they get subtracted. Okay, that's the first three things. Most of the time, this is almost always a given. Okay, this I hate to call it a given because I suppose there could be a business that doesn't have depreciation, but I don't know how it would work. So anyway, you'll always have depreciation. Then you have to see whether you have any gains or losses on what's gone on in your business. Okay. And then we're going to look at all the current assets and the current liabilities. So here's the rule. So let me put this in like I said. So if you have a current asset, so we're going to look at, this is series of adjustments. Let me put net income here. Let me put, we're going to adjust. Okay, so we'll have a series of adjustments to net income. So remember, an adjustment is either up or down. So there it is. All right, now we're going to look at, so we're going to review current assets and liabilities. And here's the rule. Okay, if an asset increases, let's see if I can, I don't know where my symbol would be. All right, I'll just put asset increase. Okay, what do you do? What do you do with an asset that increases? You subtract asset change. Subtract asset change, the amount that it changed. Okay, how about an asset that decreases? Okay, then you would add the decrease, add asset change. Okay, then you have a liability. It's just the opposite. You have a liability that increases. Okay, then you're going to add the liability change. Okay, so add liability change. And it doesn't like it. I know. Okay, and then the last one is a liability decrease. Now, you can have more than one of these. You might have 2 or 3 assets that you have to review and figure out how much they've changed and then put in the change amount, whether it's up or down. So then the last one is liability change. It gets subtracted. Liability change. Okay, and I'm going to move these over. So hang on. Okay, and this one too. Well, I thought I would. I think the hardest one is when an asset changes. You have to do the opposite. If it increases, you subtract the change. If it decreases, you add the change. Like I said, at least with liabilities, if it goes up, you add it. If it goes down, you subtract it. So this right here tends to be the hang up of most everybody when they're learning to use this recipe. Okay. So it's just a matter of figuring out. All right. So the first problem that we have, we are going to look at what section do we think a certain event would fall under? Okay, so if I go back up here and look at this cash flow statement while we are talking about each one, let's see if we can figure out where it will go. Now, this is a hard part. Okay, if you purchase investments, now this one's easy. You purchase investments, it's going to go in the investing section. If you purchase something, you're investing in a fixed asset, investing in furniture, investing in a vehicle, investing in equipment. You are sending your cash out and getting that stuff. So if you purchase something, if you purchase an investment, yes, it's going in the investing section, but it's going to go in as a what? It's an outflow, right? Yep, because you bought something and you caused cash to go down because you purchased something. But I wish they would have put another column here, and I'm going to pretend that they do, right? So I'm going to pretend that they do. So I'm going to go ahead and erase this on this side because I want you to get the feel for identifying what is happening and where it gets reported on the cash flow statement. Okay, that's the hard part. Okay, so one more time. I'm going to put A through F up here. A, B, C, D, E, F. Okay, so the first one's going in the investing section. We've determined that already. And, okay, and for my extra information, this is going to be a outflow of cash because you're purchasing something. Outflow of cash. When you purchase, you cause cash to go down, right? When you buy something, you cause cash to go down. Here comes disposal of equipment. When you dispose of something, dispose means to throw away. Now, if that said sell, you gotta go. Okay. If that said sell, then it'd be a different story. Okay, so let's see where what our options are. It's equipment. Okay, it's equipment. And I wish they would have said sold the equipment. To me, disposal means that you're throwing something away, but that's going to be your investing section. So anything to do with fixed assets are all about what's going on in investing. So I'm going to put fixed assets here. Fixed assets, buying and selling. Okay, investments tend to be, most of the time, buying and selling or getting rid of equipment. Okay? And when you dispose of a piece of equipment, so that's going to go in the investing section, but it depends on if we got any scrap value for it or not. If we got paid for that equipment, then it could be, I'm going to put could be inflow of cash if we received, if salvage value received, if we had to pay for disposal of it, right? You know, there's some things you got to pay for it to be disposed of, right? That actually could be an outflow. So it just depends on if had to pay to dispose, if disposal cost, if disposal charge. Okay, so I just want to put that there, that could be a maybe. How about a payment? Payment causes cash to go down. Okay, payment for selling expenses. Okay, what section are you selling stuff? Should be up here in operations, right? That's where your revenue, your income statement. We started with the income statement. So the payment of selling, this is selling expenses. Okay, selling expenses. Yep. It's going to be in the operating section. You say, I don't see selling expenses in this recipe. I know you don't, because it's an indirect method to getting to this. If you'll just follow this recipe, but everything that happens about selling in our business winds up on the income statement. Okay, so that's why it's operations, and payment causes cash to go down. Okay, so this is going to be an outflow, any kind of payment, outflow of cash. Okay, D, collection. Hey, we're going to collect accounts receivable. Well, that's the operating section because that has to do with selling. Okay, so it's operating, and this one's going to be an inflow of cash. But you wouldn't really know it because it's going to get accounted for using that indirect method. Okay, so if you're going to collect accounts receivable, yes, it's part of your operations. Okay, cash sales is part of your operations too. Okay, and it's going to cause cash inflow. When you sell something for cash, we cause cash to go up. So this is up, up, up. This is down. This one's up and this one's down. Just depends on the situation there. And F, finally, if you're going to issue bonds payable, the word issue means to sell. When you offer bonds with your business, you are borrowing money. So cash is going to come in because you're selling those bonds. But that's going to go in the financing section, because financing is all about how are we going to come up with the money to run this business, or to keep it going, or to do capital projects, things like that. Okay, so you need to get an idea of where those things are going to. So notice this one says cash received from sale of common stock. That would say cash received by issuing bonds, and you would put the amount you received because you issued the bonds. And then notice any cash that we pay out to retire a bond or to pay dividends to shareholders, right? So the financing section is always going to be about stocks and bonds. Okay, stocks and bonds. Stocks and bonds, whatever those implications are. That's what that section is. And one more time, the operating section is basically your income statement. Everything that has to do with the income statement, anything to do with sales and costs. Sales and costs. All right, let's go on to the next one. See what we can get done here. Tried to give you a little more introduction. All right. So here's the idea. We're going to start using that indirect method recipe. Okay, that indirect method recipe, which is right here. So here's what we've got. This is 13.2. So you've got numbers and I've got numbers. Okay, so I want to indirect method of operating section. So let me show you what this looks like here. Okay, let's start off. What's the start of the recipe? The start of the recipe is always your net income. Now, sometimes you have to work a little harder to figure out what that net income is, but there has to be a way to figure it out. So this one says, reconcile a net income of $295,000. So I'm going to put that on my screen. $295,000. It said accumulated depreciation for equipment increased by $26,000. Okay, $26,000. So I'm going to show accumulated depreciation went up $26,000. Okay, so what do we do with depreciation? We add it. Okay, we add depreciation. So I'm going to put that amount down. Now, I guess I should have included one more thing on the recipe. I forgot one piece on this recipe. Okay, sorry. So up here, after depreciation, put plus amortization. Okay, now that may or may not be going on in a company where this one is pretty much always going to be a plus. Okay, but if we have amortization, amortization is the expense of an intangible asset. Expensing an intangible asset. So the amortization expense is $16,800. Okay. There were no purchases or sales of depreciable or intangible assets during the year. If we would have had any gains or losses, then we would either add them or subtract them based on the recipe. In addition, the income statement showed a gain. So we had a gain because we sold some investments. Doesn't matter where the gain comes from. If we are showing a gain on our income statement, it gets subtracted. Okay, so I'm going to put the amount of the gain here. Okay, and you say, what does a gain look like? If you had remember, a gain is an account. Okay, I'm going to make an account for this because you would actually have to go and look at it. You'd have to look at this account and go, is there something that's been changed here? So let me put this down. This is gain from sale of investments. Sale of investments. So this gain, a gain is always a credit. It's always a credit. So if this was sitting here on the income statement or in the account, that gain that's there is $19,800. We would actually go look that up. Do we have anything in a gain account? Oh, yeah, we do. Then we would need to do what with it? Gains get subtracted when it comes to the indirect method of the operating section of the cash flow statement. So there were 3 adjustments to net income. So whatever you have here, I have $295,000. I add my depreciation, I add my amortization that they tell me, and then the fact that I had a gain, I subtract a gain. Okay. If I would have had a loss, I would have added it. Okay, if I would have, but they didn't say anything about having a loss. So my net income amount that's been adjusted for the cash flows from operating activities, we're going to show as 305,100. So that's a little different than the net income, right? So if you looked at this, okay, this is what it would say. Now, I don't know all the other things they had, but this started with, one more time, this started with 295,000. Okay, and I'm just going to erase these. And we added the depreciation of 26,000. We had amortization, so we add back amortization. And then we had a gain. And what do we do with the gain? We subtract it. Okay, so here it is. And then when I'm down here, here's how much I'm going to report on the cash flow statement in the operating section, right? This is the operating section. This is section number 1, 305,100. So remember, 305,100 is going to get added. So this is 305,100, right? Yeah. Here's how much. This is how much this section caused cash to go up. Then I would evaluate investing and financing and find out how much they are. Maybe you didn't do anything in financing, so it's getting a 0. Okay, it just depends. Just depends. Maybe you didn't buy or sell anything in investing. Okay, there's a chance that would happen. So you just put 0, but you would still account for it. Accounting for a 0 can matter, right? It means you went and looked and checked it out, okay? And you didn't just blow it off and go, well, I don't think we had one. No, don't think. Make sure you do. Make sure you know whether you had any activity. Why it's that? Hang on a minute. It's my amortization. I didn't change it. Let me start over, or let me just add back my amortization, 318,000. That gets me in trouble because the last time I did this, it had different numbers. So there we go, 318, and that's quite a bit different than 395. So, yep. So it's actually 318,000. So there we have it. If I had a little better mental math skills, I should have realized that something's not right. Okay. So I highly recommend you add things up at least twice and don't do it like I do. All right. So that's that section, and that operating section is the only one that's going to need that recipe. Okay. So now we're going to go a little further with this evaluating the current assets and liabilities. So I'm going to get rid of everything that's in my T accounts here. And then we're going to look at the different items and see how we can figure out how much they have changed, because it's the change amount that we have to do something with. Okay, so let me get rid of this so we'll wind up with wrong numbers again. Okay, here's what I would recommend. Start off with the ability to compare what's going on. So what do we have here? We have accounts receivable, we have inventory, we have accounts payable. Those are our current assets. Current assets are the first two, current liability, and then we'll talk about dividends payable here in just a minute. So let's go ahead and put in the numbers that they're giving. Okay, so we got year 2 is the first column on the left, and the year before that is the column on the right. Let's put those numbers in. So I'm going to put 22,900 and I'm going to put 22,000. So the difference in that asset is $900. Which direction did it go? It actually went up. So that's an asset increase. Okay. Well, let's just do this first. 65,100. And then you would write down inventory. Looks like inventory went down. Okay. From year 1 to year 2. Accounts payable, 16,500, 15,600. Looks like accounts payable went up. And then finally, dividends payable, 23,000 and 21,000. So it looks like it went up. All right. So we're going to start with a net income of $95,400. So that's what I'm going to put. $95,400. Now, just so that you can see this, I'm going to show you this in an account. Okay, I'm going to show you, if you like to see it a little more in a T account. I know I do. So I'm going to start with year 1. Okay, year 1. We're actually starting at the beginning of year 2. So year 1's ending balance becomes year 2's beginning balance. So yes, I know this was the ending. In fact, I'm going to put that word there. Year 1 ending balance. But this is year 2. So we're going to put 22,000 here. And then this is which is also the beginning balance of year 2. Okay, the ending balance of 1 year is the beginning balance of the next. So this is also year 2 beginning. Okay, beginning. Year 1 ending becomes year 2's beginning. That took me a long time to understand that. All right, 22,000. Then we ended year 2 with 22,900. So what happened here? We have $900 increasing, right? So we actually have accounts receivable. Accounts receivable, okay. This is an increase. Okay. So what do we do with an increase in accounts receivable? It's an asset that went up. So we want to subtract the increase. Okay, so here's what I'm going to do. I'm going to put equals and I'm going to put negative, and I'm going to go up here and get this amount, and we're going to subtract that asset increase. Okay, the next one is inventory. So once again, year 1 ending becomes year 2's beginning. Okay, so I'm going to widen this a little bit. Okay, so our beginning inventory is 65,800. The ending was 65,100. So we actually had a decrease of $700. Okay. What do you do with a decrease in an asset? Okay. What did I do here? Just a second. So once again, this is a decrease. When you have a decrease, you add it. So actually, I just let it be. Hang on just a second. Okay. This one actually needs to be subtracted. Back to accounts receivable. What's the rule? The rule is if an asset increases, you subtract the change. Okay, so I really need for this to be a negative. Oh, that's just a minute. I'm looking at this wrong. Just a second. Let me fix this. All right, this is our change. Here is where we're actually, so I have this right. Okay. All right. So what this is saying is you subtract that asset increase of accounts receivable, but you add the decrease in, okay, and then that was 700, and I want to make that equal what's up here. And this is a decrease. Okay, so this is a decrease, add change. Add change. All right, so then the same over here. This is an increase, so we subtract the change. Okay, actually, I'm going to put a plus sign here. Add change. Okay, subtract change. All right, that's why this is a positive, this is a negative. Now, accounts payable is a liability. Okay, it's a liability. So we're going to put the beginning balance, which is also the ending balance of year. So the beginning balance of year 2 and the ending balance of year 1 goes in here. So this equals this amount. And then we ended the year with a little more. Okay, so we had an increase of $900, and I'm going to put $900 in here. But because this is a liability, you just go with the direction it's going. Increase, add the change, add change. Okay, add change. All right. Now this last one they threw in just to be tricky. Okay. Dividends. Who do we pay dividends to? Does anybody remember? Who gets dividends? Stockholders. Okay. Anything to do with stocks and bonds goes where? Down here. Okay. So I know that's a payable, but it's not a current liability or an operating liability as we would look at it. So dividends payable not reported in operating section. We would actually have to account for dividends that we paid out in the financing section. Okay, and I'll put that beside there. That's why there's a 0 there. Okay, you don't, that's not part of that recipe of that. All right, so I'm going to put any dividends paid, and they have to be paid, and they have to be cash dividends. Any cash dividends paid accounted for in financing, reported in financing section. Yep, reported in financing section. So now let me see what we've got here. That never did go away. Okay. So my gosh, you say, what did we just do? Well, we had all of these, we had a couple of assets and liabilities to evaluate. And remember, we evaluate them based on, where am I at here? Oh, based on whether they're current or not. Okay, whether or not they're current and whether they're happening because of operations. Dividends don't happen because of operations. Dividends happen because of financing. So once again, I started with net income of $95,400. We looked at this accounts receivable, which is an asset that went up. So we subtracted the change. Okay, we subtracted the change of that asset. Then we looked at the inventory asset and it decreased. And when you look at an asset that decreases, you add the change. Okay. And then we looked at a liability that had increased, right? So I went from 15,600 to 16,500. That's an increase in a liability. You add the change, and then the dividends payable, it is a payable, which means it is a liability, but because that's not what we do in operations is pay out dividends, that is not included in the operating section. So my net cash flow from operating activities based on this information should be 96,100. Let's see if I've paid enough attention or not. Okay, yep. There it is. Okay, let's keep working. I'm going to keep working. Okay, now let's do a little more of a cash flow statement. So we're going to, and I won't use T accounts this time, but we're going to do that indirect method of the operating section. So we always start with net cash flow, or I'm sorry, we always start with net income. I've got 471,000. Depreciation, they have given it to us. So you add depreciation. They have given us a loss. So you'd have to go back and look at your recipe, but a loss gets added back. Okay. Now we have an increase in accounts receivable. So an increase in an asset, we need to subtract its change. This is the increase. This is not the amounts that we have to figure out the increase or the decrease. That is the increase. Just like the next one is the increase in accounts payable. So let's go ahead and put this in. I'm going to go ahead and finish. So once again, my accounts receivable had an increase because it's an asset. You subtract the increase. You subtract the change. So it changed by $18,300. Accounts payable increased, right? What do you do with an increase in a liability? You add it. So I'm going to put 4,500 there. So if I have followed along close enough, paid attention, it looks like we had a net income of 471,000, and because of the indirect method, we are now reporting net cash flow from operating of 559,100. Okay, so I'm going to go ahead and now put that in. And this is just a partial statement of cash flows. This is the first part. Remember, there's two more parts after that. So let's go ahead and start off with net income. We're going to add depreciation. We're going to add a loss, any loss that we had, change in current operating assets. Actually, yeah. Okay, so we had an increase in accounts receivable, and then we had an increase in accounts payable. Okay, so one more time, I'm just going to fill in what I have over here on my spreadsheet. 471,000 is the net income. We're going to add that depreciation. We're going to add the loss. We're going to subtract the increase in accounts receivable. And I think they want minus sign to indicate outflow. So that I do believe they want that in as a negative. And then we're going to add the increase in accounts payable, 4,500. When you do those four adjustments to net income, 559,100. Okay, 559,100. So there is using the recipe. A little more. All right, let's keep going. Okay, this one, we have the same numbers, and 6, we have the same numbers. So if you want to follow along. All right, land transactions on the statement of cash flow. So it says IZ Corporation purchased land, purchased it. Okay, and this is 13.5, right? Yeah, okay. Purchased it for 475,000. Okay, we'll come back. Later in the year, the company sold a different piece of land with a book value of 210,000 for 265,000. So we had two activities in the investing section. Okay, and there is a piece of it that also goes in the operating section. And here's how we know. Okay, so let's go look at the investing section first, and then we'll come back to the operating. Investing, we always want to put down if we've sold something, we want to put an inflow in first. So the cash we received from the sale of the land, I've got 265,000. You say, what about the book value? We'll get to the book value in a minute. Okay, just put down how much did we receive from selling that land. Okay, we received 265,000. So I'm going to put action. Okay, so we're going to, it's part of cash flows from investing, and it makes it go up. Okay, 265,000. Okay, now, how about the cash paid for the purchase of the land? So the first purchase is 475,000. That's an outflow of cash. So I'm going to put this in as a negative amount in the investing section. So this is part of cash flow from investing section, but it's going to go in as a negative because it causes cash to go down. Okay, so what's the difference? Okay, now let's go take care of the gain. You say, how do you know it's a gain? Because we received cash from that second piece of land. When we sold it, it had a book value. Okay, so here's what I want to show you. Let me make a extra line here because I didn't do a very good job describing this. So this is the selling price of land, or the proceeds from the sale, minus the book value of land. Okay, so I've got 265,000 minus, this is why you keep the book value, and land doesn't depreciate. So we bought it for 225,000, or to get it ready for us to use cost us 225,000. Now I'm going to subtract 210,000 from 265,000. So, and what do we do with this? Is going to be a gain, right? We got more than we paid for it. It's kind of like selling stock at a higher price, right? So we paid 210. So I believe we're looking at a gain of 55,000. What do we do with a gain? A gain gets subtracted in the operating section. So it gets deducted from net income. So I'm going to put this in as a negative value and see if we're right. Now I want to make sure I've got my numbers right. I sold the land for 265, or we did, because we are using the same numbers on this one. We sold the land for 265. It had a book value of 210,000. That means we paid 210,000, and now we're selling it for $55,000 more. Well, when it comes to cash flow, Even if it's a gain, you subtract it. When it's a gain, you subtract it. If that would have been a loss, if we would have sold that for less than its book value of 210,000, we would have a loss. Either way, a loss or a gain gets either added or subtracted to net income, right? And then the full amount of cash we received for the sale of the land, which was 265,000, and then the cash we paid for that purchase, right? And that's just how, that's why we call. So these two are going in the investing section. This one's going in the operating section as part of that indirect recipe. Remember, when we get down to the investing and the financing section, whatever effect it has on cash, whether it's going up or down, that's what we put it in. So if we were to look at this, the net cash flow used by investing activities would actually, if that's all the investing activities they've had, they would actually have a negative cash flow in that investing section of 210,000. And then up in the operating section, we would account for that gain by subtracting it as a deduction from net income. Okay. Woo-wee. All right. This next one, where's 6? Did I skip 6? I guess I did. What is 6? Hang on. Maybe I put it down here at the bottom. Yeah, I did. Okay. Let's go to 6. So now we're going to be looking at the financing section. You say, how do you know? Because they're talking about common stock, they're talking about bonds, they're talking about paying dividends, and so forth. All right, so let's see. So just like we did the investing section, we're going to see if there's anything here that caused cash to go up. Okay, so it says Jones Industries received $600,000 from issuing shares of common stock. Well, that's cash coming in. Okay, so up it goes. And that's going to be an increase. It's part of the financing section. So all of these are part of the financing section. So, okay, all of them. And then, okay, cash received. So how much cash did we receive from selling the stock? 600,000. Okay, how much did we receive from selling bonds? 475,000. I'm going to put that in my spreadsheet now here. So 600,000 came in from selling stock, and 475,000 came in from selling bonds. Now, the dividends. It says they also paid, and that should say cash dividends, of $80,000. Okay, $80,000. So that's going to cause that financing section to go down because it was because of the shareholders and the stock outstanding that we paid those dividends to. But when we paid them out, that made our cash go down. Okay, it made the cash go down. So if that's all there is in the financing section, so I'm going to take this just one step further. If that's all there is in the financing section, then we're going to get a net cash amount here. We're going to add these together, and we would have we would have what's called a cash flow. So this is a increase or cash flow from, because from means increase, used means decrease. Cash flow from financing section of a positive 995,000. So that would explain, if that's all there is in the financing section, that would explain that one section of the cash flow statement. Okay, back up to 7 now. All right, we have a concept called free cash flow. And wait a minute. Okay. All right, free cash flow. Here's what here's the information from the book, what free cash flow is. So here's what it is. It's a valuable tool for evaluating the profitability of a business is something called the free cash flow. Free cash flow measures the operating cash flow available to a company after it purchases the property, plant, and equipment necessary to maintain its current operations. Since the investment in PPE necessary to maintain current operations cannot often be determined from financial statements, analysts estimate this amount using the cash used to purchase property, plant, and equipment as shown in the statement of cash flows. Thus, free cash flow is computed as follows. So, if we had a positive number in our operating section of our cash flows, so here it is, net cash flows from operating. Okay, I'm going to put these numbers in. Okay, I'm going to put these numbers in. So net cash flows from 2001 is 554,600. Net cash flow from operating year 2 is 661,200. Okay? So then it says the free cash flow can be expressed as a percentage of sales. Okay, as a percentage of sales in order to provide a measure that can be compared over time or to other companies. The ratio is computed as follows. So ratio of the free cash flow to sales is free cash flow divided by sales. Okay, well, we've got to figure out. Okay, so one more time, the cash flows used in, here's what we need. Of the net cash, so let me read this. So net cash flows from operating activities. This came from the cash flow statement from year 1, year 2. So we're looking at an increase in cash from one year to the next because of operations. And now we're looking at the net cash flows from, or used, right? Used means decreased, and used means decreased. So last year, because of investing activities, it caused our cash to go down 402,000. This year, it's causing our cash to go down 439,000. All right, so let's go ahead and we'll be putting these numbers in. And the financing is just in there just to confuse you. Okay, now it says of the net cash flows used from investing activities, 80% was used for the purchase of property, plant, and equipment. So that's what I have here in this little part that's calculating something. So I want you to take the amount from year 2 for investing and take it times 80%. Okay, so I've got 439,000. And if you need to go, that's fine. I'm going to keep going. Okay, and I'm going to go ahead and do I'm going to do the coursework too. So thanks for coming in. All right, so we're going to do 80% of the investing activities for year 2, and then we're going to do 80% for year one. Okay, so let's go ahead. And we're going to have to do some subtracting first to get that free cash flow. So year one is 402,000 times 80. And now I've got to put those numbers in here because I've done the math for that. So we're going to put 439,000 times 0.8. And we're going to put 402,000 times, right? So 402,000 times 0.8. So we have to subtract based on this free cash flow information, and they're not asking for the ratio of it. Okay. The free cash flow from year two is the net cash flow from operating and subtracting, and it should be 80%. I don't have that showing up right here. Just a minute. Let me go back. There we go. 80% of investing is used to purchase PPE. So they had to tell us that. Okay, they had to tell us that. If they wouldn't have told us that, we wouldn't have known how much of that was used to purchase PPE. Okay, used to purchase it. So we have to subtract it. So now we can say that let's do year one. So 554,600 in net cash flows minus 80% of 402,000, which is 321,600 is 233,000 for free cash flow year one. Year two is the same calculation. So free cash flow is getting bigger. And this is a good thing. It says, has Dylan's free cash flow improved or declined? Well, if you're getting more cash flow, then that is an improvement. Okay, it's improving. If this was going the opposite direction, if last year, if year two was less than 233,000, then that would have been a decline. Okay, boy, I'm glad I put this information here in from the book because, yeah, I wouldn't have remembered that calculation off the top of my head. All right, now let's go to number 8, and we're going to finish up now. This is the direct method. Now, I want you to know that it exists, okay? But I don't want you to get hung up on calculating it because I'm not going to teach you this. But that operating section, we've been using the indirect method. There is a direct method for the operating, okay? And this is how you might need to calculate it. So you're going to start off with how much is in sales, okay? I got 230,000 in sales. The accounts receivable balance decreased by 17,100 over the year. What do you do with a decrease? You add it. So we're going to add the decrease in accounts receivable. So my decrease is 17,100. So there is the amount. So the account receivable balance decreased by 17,100. That's what they're telling us. What do you do with it? You add a decrease. So it looks to me like 247,100 is the amount of the cash we received because accounts receivable, right? Accounts receivable means we sold something but haven't received the cash yet. So don't get too hung up on this. Just follow along. Okay, and then the last one that we're going to do the same one here. Okay. This last one is the operating section and it is the direct method. And I put the direct method in here. Here's cash received from customers, what you do. Then you take the cost of goods sold. So we started with sales and subtracted the increase in accounts receivable, and we got the cash received from customers. Now we're going to take the cost of goods sold, and we're going to add any increase in inventories and subtract any decrease in inventories, and then add a decrease in accounts. So this gets kind of crazy. So let's see what we can do here. Let's start with the cost of goods sold. Okay, my cost of goods sold is $185,000. Okay, my accounts payable balance increased by $8,000. Inventory increased by $11,100. So, to the cost of goods sold, it's kind of the opposite of what I was just teaching you. Okay, it's kind of the opposite. I know. That's why I try not to teach both of these. So, what do you do with an increase in accounts payable? What happens? So, an increase in accounts payable gets subtracted from the cost of goods sold, because this is a cost, not a sale. Okay, it gets subtracted. So what is the amount? So we're going to subtract that increase in accounts payable. Remember, this is the direct method. Direct method. And I'm not going to make you do any calculations on that. I'm not going to make you do any calculations on that. So just be aware that these last two are the direct method. I just want you to know it exists. Okay, it does exist, but the indirect method is required by GAAP. So I don't even know why they mess around with the direct method. They mess around with the direct method in the account, in that operating section, because to a person that doesn't understand accounting, the direct method is easier to understand. Okay, it's easier to understand, but it's not always easier to calculate it. Okay, so once again, now we took an increase in inventory and we added it. So we would subtract the increase in accounts payable, and this is the opposite, the complete opposite of what we did for the indirect method. So the direct method, you subtract an increase in accounts payable. Yep, it's the opposite. So just try to, I would just use the indirect method. And like I said, GAAP wants it reported anyway, so we might as well just stick with it. Okay. All right. So I have determined the amount paid for merchandise. So once again, this is the cost of what we paid, cost of our goods sold. So accounts payable, an increase in it means we got merchandise that we didn't pay for. So we need to subtract any increase in accounts payable, and inventory went up, right? So any increase in inventory is an increase in the cost of goods sold. So that's why those get added. So that's it for the intro exercises. Okay, Oscar and Jackson, that's it. Okay, I'll be making another video for the coursework for chapter 13. And let me double check my work before I move on. There we go. Okay, guys, I'll have another video out here. I plan to stick around and just do it. See ya.